Good day, fellow investors. One of the highly requested stocks is Domino Pizza Group Enterprises. All the free Domino's stocks, I've looked at them. So we have Domino's Pizza Group, has been a compounder, and now many ask of you whether this is just a temporary downturn, and then if it just reverts to the normal, there you have a 2x on a margin of safety, P ratio of 10, a high dividend yield, high cash flows. It has happened already a few times. Each time those that bet on it have made a 2x. There is also Domino's Pizzas, NASDAQ we'll discuss, but the metrics there are different and the numbers are better. And also the Australian European company that has been in a boom and now is already 90% down. The dividend is still there, but we'll get to it and you can see which one of the free Domino's stocks you like the most. Let's start with Domino's Pizza Group. This is UK and Ireland. So they have the results and sales are flat, free cash flows are down a little bit, EBITDA down, earnings per share down, but everything is still very profitable. There is still cash flow, there is still underlying EBITDA, so nothing wrong with it. Just a market decline, a slowdown in the UK, likely inflation is hitting them as it is doing on the customer globally. Margins a little bit down, earnings per share down 29%, that's always the most volatile factor, but the free cash flows are there and they have done over 500 million in dividends and buybacks, so that is something when compared to the current market cap of just 775. If they can do it again in the next 5 years, that is 70% of the market capitalization, and that should lead to good returns. They are trying to do investments, they are trying to do an acquisition, so they are assessing opportunities for a second brand with strict financial and strategic guardrails. And on the result, they are still increasing their market share, which means it is the UK market, the UK consumer that has been hit, not the company, which again indicates that it is a good, stable business. The outlook is pretty much flat. They should do okay. If they can buy something and then scale it like they did on their asset-light platform, it should be okay for investors. Plus, you're buying something at the cash flow of 10. If they can just maybe even grow in Ireland, it should do okay. Let's dig a little bit deeper into the financials. If you look at the numbers, there is some debt, 600 million. Okay, compared to the market cap, it is a lot, but they are doing a lot of buybacks, which means also the equity is then destroyed, asset-light models like Apple, like cash flow. And if you look at the long-term trend, there have been some hiccups in the past as now, but we are still up. If we would measure things from a 2-year perspective, they should still be growing there. So it is a downturn in the UK. Even if they are flat, the investment should be okay. If you look at the numbers, it is a business that is still growing. Net income is more volatile, up and down, up and down. Now we have been flat on the 5-year side, but okay, it could be better, but if it would be better, it wouldn't be as cheap as it is now. Free cash flows again are there. We are at 10-11% free cash flow yield, which is okay. The capital expenditures are low, which means it is a business that can make good returns on capital, which is what Warren Buffett also always wants. So it looks from this perspective a 10% return just from the cash flows. Now, is it a stock to buy? We have to assess the risk and reward, and then you can see how it fits your portfolio. It is clear they are looking for a second brand for the next decades of growth. They tried to acquire Wingstop, a private equity firm, bought it off them, so it's okay. They didn't want to overspend for it like private equity does these days because that's the environment we live in. So very interesting. If they find something, that is then the uncertainty. If the market likes it, the stock will boom. If it doesn't, then it can still be an issue. They will likely take more debt to do the acquisition. The inflation has been negative, but here they say it's the best economy, second best of the G7. There might be improvements as it is expected to grow significantly, but there is this stubbornly high inflation expectation. So the unknowns is an acquisition. If you go into a transformative acquisition, it can be bad, jack in the box, things like that, or it can be good. And the fact is that nobody knows. So that's the risk and reward. There is a 10% free cash flow yield. Likely the markets will stay stable in the UK. So we have this stability. If everything goes wrong, you have your 5% dividend, which is okay. Then they can repackage it, sell it to some private equity or something like that. So it seems that it is already interesting for a starting position. And then if they hit that growth for the next 20 years on some great acquisition, it might have ups and downs, then it is a very interesting business proposition. Let's compare it to the parent company. So even compounding, all good, but the P ratio here is already 25, the dividend yield is not 5, is 1.64. They are still growing, they are half US, half international, good growth numbers, all good. We look at the profits. There is long-term debt that they are using to buy back shares because the equity here is totally negative. Okay, revenues are growing, debt is growing accordingly, nothing wrong there. Net income, same there, stagnant, now growing a little bit. I would say it is fairly valued in this market, expensive in a value investors market, likely a good business. Let's just look at Down Under, Asia, and they also own Europe. It's an intricate mess, but okay, you accept it. This is ugly. This is something very ugly. But then I look, net profit for the year, 160 million. I don't know if it's US dollars, Australian dollars, but compared to the market cap in Australian dollars, that's either a P ratio of 10 or 15. Now they have issues, they are not growing anymore. It's difficult to grow. The business model works in the UK, in the States. In some countries it works, in Italy it was a debacle, things like that. So Asia down 32%, closing, Japan closure, so things like that. Global EBIT down, hard to scale globally. Then they say there are no recurring items, restructuring organization, and it often happens to be recurring, so enjoy my beautiful design of a flag. The balance sheet, if I look at here, non-current borrowings, other liabilities, that is 8 times net income, which is very, very risky. But if things improve, the company will 5x like it was, or 10x like it was a few years ago. That's always the risk with these risky bets. However, if I have to put Domino's at the quadrant, we are getting here crowded at our around 10% return. I'm putting everything a little bit down on the risk. Here we are, and perhaps this should be a little bit less risky, but UK, Great Britain pound, things like that, keep it a little bit on the riskier side. Now, this is a bunch of stocks here. At the end, we'll follow them, we'll see, we'll learn, we'll eliminate the bad, we'll stick to the good ones. At the end, you just need one to buy every year or 2 years, not all of them. So, very interesting situation. We'll keep updating on earnings, on things, on acquisitions, and see whether at some point, I think it's already good, perhaps I'll check it for my diversified portfolio at the end of the month, but that's a different story. Thanks for watching, I'll see you in the next video.